So what is a kite spread? Well, chances are this is not a strategy or a spread that you're familiar with, but as you'll find out, it is made up of strategies that you probably use all the time. It's made up of either calls or puts combined with vertical spreads. So what is a kite spread and why would you use one? Well, let's go have a look. And as always, before we do, please be sure to click like and subscribe. It's very much appreciated and definitely helps to promote the channel. So a kite spread, there's two versions like there are for most strategies. We have a bullish version and a bearish version. For this video, I'm just going to talk about the bullish spread. So a bullish kite spread is going to be made up of multiple bear spreads, and then you're just going to purchase one long call below the lowest strike. So I know it sounds confusing, but for example, let's say that you sell 5 of the 100-105 call spreads. Those are credit spreads, they're bearish spreads. And then you would buy one, let's say, of the 95 calls. So notice that this 95 strike is lower than or less than this 100 strike. That's what this bullet is talking about. Could you buy the 90 call? Sure, as long as it's below this lowest strike. So to see what's happening, let's break it down. Let's take a look at just the bear spread first. This is the 100-105 bear spread. As always, we get our bends right here. Now, if we just did the spread one time, this would give us negative 100 deltas between these strikes. That's the same as being short 100 shares. However, let's say that we did this spread 4 times. Then this little line right here would actually be minus 400 deltas. But as I've pointed out in previous videos, it's going to look the same on your broker's platform. And the reason is that instead of changing the angle of the line, the broker's platform is just going to change these numbers over here. They're going to get multiplied by 4. So visually, it's going to look exactly the same. So to really see what's happening, let's overlay one short spread with maybe 4. Now it becomes very easy to see these deltas. You see how much steeper this line is right here in blue? Compared to the red is relatively flat. And this is getting very steep. So this is now short 4 contracts right through here, or 4 spreads. So on the red spread right here, short 1, we have minus 100 deltas between our strikes. But on the blue spread, we've got minus 400. And so that's really part of what's making this strategy tick, is by selling off multiple, in this example, bear spreads, we're going to get very sharp deltas between the strikes. So now let's take a look at the bear spread and overlay the 95 call. Now take a look at the extremes. On the vertical spread, we have 0 deltas out here in the left wing. We have 0 deltas out here in the far right. But for the long call by itself, we have 100 deltas forever. And so eventually, once the stock price gets above this upper strike, this long call, these 100 deltas will overtake this 0. And so eventually we know that we've got to have positive or unlimited deltas in the extremes. We can also see to the far left, we have a flat line matched with a flat line. We're only going to have a limited risk. But the real risk comes between these strikes. What's going to happen, let's say if we're long 100 shares, but maybe short 4 or 5 or 6 or however many spreads that we're short. So let's take a look at that. Let's look at a kite spread. This is what it's going to look like. This is the general shape. Now, of course, depending on how many calls you're long or how many spreads you're short, you'll get different angles and different depths of the max gains and losses. But here's what it looks like today, maybe with 30 days to expiration. And then as time passes, eventually these red lines move towards the blue. So the blue is the expiration graph. So now it becomes very clear to see where the maximum risk is. It's not out here to the left. And that's because we have lots of negative deltas through here. In this example, we're only long 1 of the 95 calls, but we're short 5 of these vertical spreads. So we've got negative 400 deltas through here. But the point is that we have limited risk out here. We've kind of boosted this left side up. We are accepting potentially higher risk right here at this long strike. But look at all of this gamma. If we get an explosive move to the upside, look at the curvature in there, and that's again because of the ratios right in between these strikes. So if we get that explosive move to the upside, this can be a really powerful strategy. So what's one reason why we might use a kite spread? Well, this starts to get a little complicated because there's really a lot of different reasons. But a very common one is, let's say that we were initially long the $95 call, but the stock falls. It's gone against us, volatility spikes, but we're still bullish. We're looking for a big turnaround for whatever reason. Well, we might sell 5 of the 100, 105 call spreads. And with a high volatility, we get this nice big credit. And what have we done? We've offset the cost of this call. And so we might get into this type of a profile. So maybe our long 95 call might have cost us $5 down here. But by selling off these spreads, we've lifted this left portion up, potentially even into positive territory. We can make a gain if the stock sits below this short strike. We do have additional risk if the stock rises just up to this long strike and then kind of sits there until expiration. But if we get that explosive move, we've got all of this gamma and all of these positive deltas waiting on the right wing. So that's really just meant to be a little overview. It's not getting into all of the hows and whys and the details, but I just wanted to at least let the group know what is a kite spread in case you ever hear of it, and to also just show you how powerful and versatile strategies can become when you start combining them with some of the basics. And so for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on Options A to Z's Facebook trading group, and you can find a link in the description below.